Hello everyone and welcome back to another video with Business with Professor T, and today we're going to be looking at features of financial institutions. So to start with, we have the Bank of England. The Bank of England is at the top of the pyramid, so to speak, of the financial institutions, and the Bank of England is the UK central bank where they print banknotes. They control the inflation rates, so when inflation needs to be up, it goes up. When it needs to be down, it goes down. They supervise banks and insurers, and they also ensure stability in the financial system. Now we know that the Bank of England is a safeguarding mechanism to ensure that all the financial institutions and insurers are acting in accordance or in the best interest of society. Now let's look at the advantages and drawbacks and sort of evaluate the benefits or the purpose of the Bank of England. So the Bank of England is independent from the government and financial institutions. So they are an independent body. They focus on managing the flow of money in the economy. The Bank of England considers regional, national, and global factors when making decisions. And essentially, the Bank of England helps to create financial stability and confidence across the whole financial framework. So now we look at the drawbacks of the Bank of England, and the first thing that we see is decisions can damage the financial institution. So the Bank of England has so much power and so much weight within the financial framework. So any wrong decision can be catastrophic for the whole economy at large and for the whole financial framework at large as well. Now, there are some questions about the legitimacy or the independency of the Bank of England to the government. So the Bank of England should be an independent body, but there are some questions or ambiguity when it comes to how independents are there. So in a spectrum, there is questions about how far they go in being independent. And then another drawback is that the directions or the decisions or like the final say about the whole economy comes from one person, which is the governor of the Bank of England. And last but not the least, the decisions are not always representative of the whole UK's need. So the Bank of England might focus on a specific demographic or a specific need, but that does not reflect or that does not account for the whole need of the UK. So now we understand how the Bank of England works and how they are the governing body for the different financial institutions. We now look at various financial institutions in more depth. So we start off with the bank. A bank is a place where money will exchange hands. Banks offer a range of services. Most common ones tend to be lending and saving based. They are now also increasingly payment agents. Banks offer a safe and secure place to keep items of value and are the main financial focal point for most people in the UK. Banks tend to be privately owned, so their primary focus is to make profits for their shareholders. Now looking at the advantages and drawbacks of banks, we start off with a bank offers a wide range of financial packages that the customer can have access to. They tend to have physical presence in the high street as well as online, offer convenient access to money and account, and most importantly, keep money safe and secure. Looking at the drawbacks of banks, banks are privately owned, which means that their primary objective is to make as much profit as possible for the shareholders. As a result, low interest rates are paid and bank charges are also likely to occur. Now, across the banking sector, there is a low level of customer service because customers are resistant in switching from a high street banking process to an online banking process. And as a result, access to branches is declining across local areas. Now looking at a building society similar to a bank where money would exchange hands. They offer financial services mainly based on lending and savings. A building society is mutual from ownership. What this means is that customers are members and they have voting rights to elect who runs the organization and also get a share of any profit. Building societies tend to be more locally based. However, over time, they have started to grow and expand. Evaluating the advantages and drawbacks of a building society is mutual and they have the members' interest at heart. A building society will share the profits back to the members and will invest in a better financial service. They tend to be local and more personalized, and they offer a range of financial services. Looking at the drawbacks of a building society lacks the level of coverage that larger banks tend to have. They also lack the economical scale to compete with larger financial organizations. Furthermore, they lack the level of range of products and services offered by larger financial organizations. Moving on to credit unions. A credit union is a community financial organization serving personal and small business needs. They tend to offer many features of a bank. They focus on service and not profit. So this means they offer better rates in interest and in fees. All decisions are democratically made by members and all profit is invested back into the organization to provide better rates. Credit unions are regulated by the Financial Conduct Authority. We now look at the advantages and drawbacks of a credit union. A credit union is customer orientated, so customers share a part ownership of the organization, so they have voting rights and receive dividends. Interest rates tend to be better than those offered by banks. Community interests are the main focus above and beyond profits for credit unions. The drawbacks of credit unions are there is a reduction to access the branches and cash machines. There is a reduced level of service that they can offer customers and difficulty to find credit unions in many areas these days. Another financial institution is the National Savings and Investments. They are state-owned savings bank. The purpose is to attract funds from savers that can be used to fund government projects. They offer a range of savings products that are tax-free in some cases and are 100% guaranteed. Interest rates, however, tend to be low. Because of this, they are not as competitive as you would expect from other lenders. Now looking at the advantages and drawbacks of a national savings and investment. Starting off with the advantages, it's backed by the government, so investments are 100% safe. Returns are tax-free in most cases, and it is a quick and easy way to invest money with the chance of winning prize. If you have a premium bond. The drawbacks are the national savings and investments caps the level that can be invested in many of the financial packages. Interest rates tend to be fairly low on average. Money tends to be locked into fixed periods of time before it can be withdrawn. Limited range of services and accounts on offer. We now look at another type of financial institution, which is insurance companies. Insurance companies are an organization that provides protection in the form of compensation should the policyholder suffer loss, damage, injury, or hardship. Insurance companies are large public limited companies who aim to make a profit. Many insurance companies will assess the risk that they are covering against, also will charge the customer increased premiums. They also offload any high risk policies to other larger insurance brokers. Scrutinizing insurance companies' advantages and drawbacks. Starting off with the advantages, insurance companies are regulated via government legislation. They provide a range of services and packages. They offer reassurance and protection from risk. The drawbacks of insurance companies are they aim to make a profit and that is reflected in the price charged. Insurance companies tend to be faceless and not offering a face-to-face service. Insurance companies can be complex and require a good level of reading and understanding of paperwork. And now we look at pension companies, which is another type of financial institution. A pension company is an organization that provides a financial service in the form of a pension that customers can save towards their retirement. Pension companies tend to have, or tend to be rather, large public companies who typically are linked to other financial institutions with the aim to make a profit. Pension companies typically work by making an estimation on how much could potentially be available to the customer on retirement if they invest a set figure, and then this money will typically be invested on the stock market with the aim to increase the value of the investment. So, evaluating the advantages and drawbacks of a pension company, starting off with the advantages. Pension companies are regulated by the government to ensure protection. They offer a controlled and management form of future investment. Pension companies can be a form of tax relief. Pension companies also aim to make a profit, which means they'll try and maximize profit. The drawbacks of a pension company is that it is privately owned and it is a private organization with the aim to make a profit. Pension companies tend to lack the face to face personal approach, and they offer a wide range of packages which can be confusing for users and customers. The returns can be much dependent on the performance of the stock market, so it can vary from a high return to a low return based on the performance of the stock market. The next financial institution is a pawnbroker. Now, a pawnbroker is an organization that provides a loan against items that have been offered up in the form of security. A pawnbroker is a private organization who will have the aim of making a profit. So typically, the interest rate charged is between 5% to 12% per month, which is quite expensive. So the process in which a pawnbroker operates in is that the customer will give the pawnbroker an asset that they own. They will ask the pawnbroker to give them a value of the asset, and then this will be used as collateral on the loan. When they pay the loan in full, the asset will be given back to the owner or the person who's taken out the loan. And then if they do fail to pay the loan, the pawnbroker has the right to sell the assets to recover the money loaned out. Evaluating the advantages and drawbacks of a pawnbroker. Starting off with the advantages, a pawnbroker wouldn't carry out any credit checks. So if you have a poor credit rating, you can still borrow. It is a quick form of borrowing, so money is usually paid the same day. Assets can be redeemed at any time, and interest only charged on period money is lent from. The pawnbroker has the responsibility to value the item correctly. The drawbacks of a pawnbroker is that it is a fairly expensive form of borrowing. Borrowing tends to be restricted to a percentage of the value of the item pawned. The last financial institution we're going to be looking at is a payday loan. A payday loan is an organization that provides loans that are for a short period of time to cover unexpected costs before the customer's next paycheck. Payday loans are private organizations who have the aim to make a profit. They typically charge high rates of interest, which means they can become expensive if you don't pay them off as expected. The customer would typically apply online to take out a payday loan. They could have to complete some form of basic credit check. However, the loan is typically transferred within hours to the account of the customer once approved. So, evaluating the advantages and drawbacks of a payday loan. Starting off with the advantages, a payday loan is a quick form of borrowing, so money is usually paid the same day. Payday loans are fairly easy to set up with low operating overheads. Payday loans have increased choice of competition for the customers to choose from, and payday loans are a useful source of finance if used in the short term and repaid in full. The drawbacks of a payday loan is it is a fairly expensive form of borrowing, especially if you default. Payday loans allow lending to people who are vulnerable and who have poor financial management. Payday loans charge high fees for people who default on repaying the debt. And last but not the least, payday loans have no face-to-face interaction with customers. Thank you for watching today's video. That concludes the end of the various features of financial institutions. If you've enjoyed this video, give it a thumbs up. And also, if I've earned your subscription, subscribe for more educational videos. See you next time.